Okay, let's unpack this. What if the economic picture we've been looking at, the one suggesting the U.S. economy is incredibly robust, isn't quite as strong as we've maybe been led to believe? Today, we're diving deep into the state of the U.S. labor market. This is usually, well, a rock-solid indicator of economic health, but lately the data seems to be telling a more complex, perhaps even a concerning story. Our mission here is to really understand the recent deceleration in job growth, what these significant upcoming data revisions could actually mean for our understanding, and how all of this impacts the Federal Reserve and the broader economic outlook, especially for you.
Absolutely. And what's fascinating here, I think, is how deeply intertwined these numbers are with major policy decisions that affect every one of us, and also how they shape our fundamental understanding of where the economy is truly headed. It's not just about, crunching historical data. It's about what that history suggests for our collective future.
Indeed. And look, we've been hearing a lot about a slowdown in the job market, but our sources suggest it might be even more pronounced than initially reported. Let's maybe start with some interesting insights from an analysis of U.S. employment data and Fed policy. What are the immediate challenges we should be aware of, things that might be flowing under the radar?
Well, the most immediate and critical detail is that U.S. employment growth has effectively stalled in recent months. That's the headline. But what's perhaps even more noteworthy is that economists believe the slowdown may have actually begun much earlier than generally perceived.
Earlier.
Yes, much earlier. So this isn't merely a recent dip. It's more like a recognition that the underlying trend of slowing growth has been building for a while, almost quietly, beneath the surface.
Wow. Okay. That's a powerful revelation. If the slowdown started earlier, does that imply our previous understanding of the economy's robustness was maybe built on, well, shakier ground? And if so, what's coming up that will shed more light on this potential historical miscalculation?
Precisely. The Bureau of Labor Statistics, the BLS, is due to release a preliminary benchmark revision to payrolls. This covers the 12 months leading up to March. And this is a critical piece of employment data coming just before the Federal Reserve's monetary policy meeting next week. It's not just a regular monthly report, it's a really profound reevaluation of past data.
Okay, a reevaluation. And what are economists anticipating from this revision? What's the expected impact on those numbers we thought we knew?
They're predicting a substantial downward revision. The anticipation is that it could reduce the previously reported payroll count by an estimated 700,000 to maybe 800,000 jobs for that period.
7 to 800,000. That's,
Yeah.
I mean, to wipe nearly 1 million jobs off the books retrospectively, that's a staggering figure.
It is. It's a huge number.
So if that revision comes in as predicted, what does such a substantial recalculation really tell us about the underlying momentum, or maybe the lack of it, entering this year?
Well, Comerica chief economist Bill Adams puts it quite clearly. He suggests that if this revision is as negative as predicted, it indicates the economy had, quote, less momentum entering 2025 than previously believed. And think about the ripple effect here. If businesses, investors, were making decisions based on what turn out to be inflated job numbers, well, this revision isn't just a historical correction, it's really a recalibration of future expectations. It could potentially lead to more cautious hiring or investment plans across the board. It suggests we're starting from maybe a weaker footing than the initial numbers conveyed.
Right, it's about the whole picture, the foundation. But how much immediate sway can a historical revision like this truly have over forward-looking policy decisions, especially for a Fed meeting that's just next week?
That's a fair question. While this specific revision might have less immediate punch than a fresh monthly jobs report, a really weak revision certainly adds significant weight to the arguments for loosening monetary policy. It could pressure the Fed towards interest rate cuts, you see, because it paints a picture of an economy that might need more support than previously thought.
That makes sense. It's about understanding the true landscape before making a move. But speaking of the BLS, our sources also touch on some of the methodology behind these revisions and, well, some of the criticisms it has faced. Can you elaborate a bit on why these large revisions happen? Is it common?
Sure. The BLS annual benchmark revision is based on something called the Quarterly Census of Employment and Wages Program, the QCEW. It's actually a very robust system. It tracks over 95% of U.S. jobs through actual employer payroll records, so it's considered the gold standard eventually. The final definitive revision using this data is expected in February. However, the BLS has faced criticism recently due to these large downward revisions in the monthly employment data that comes out before the benchmark.
Yeah, I recall hearing about some of that criticism, even from political figures in the past.
Indeed, it includes past criticism from former President Donald Trump, who alleged data manipulation. But putting politics aside, these larger revisions in recent years seem to be partly attributed to a couple of key factors. First, response rates from employers for the monthly surveys have been declining. That just makes it harder to get perfectly accurate, real-time data.
Okay, lower response rates. What's the second factor?
The second is the BLS's birth-death model. This model tries to estimate jobs created by brand new businesses or lost when businesses close things that are too new or too small to be captured by the regular surveys immediately. But in a highly dynamic, fast-moving economy like ours, predicting these births and deaths in real time is incredibly difficult. And that can lead to these later, sometimes quite large adjustments when the real data comes in. It's a continuous challenge, really.
Okay, so that's the rearview mirror, the adjustments to past data. Let's shift to the dashboard now. If those past numbers are being adjusted down, what's the immediate picture telling us about the job market today? Our sources, including insights from Goldman Sachs, indicate a truly weak jobs report right now.
Yes, according to Jon Hatzius, Goldman Sachs' chief economist, employment growth has really taken a clear step down. His preliminary estimate suggests we've only seen about maybe 29,000 new jobs created on average over the last 3 months.
29,000, that's
Yeah.
that's a dramatic drop from what we might typically expect just to keep pace with population growth,
Yeah,
right?
exactly. It's quite low.
So what does that mean in the broader context of, say, labor supply and the health of the workforce?
Well, this level of employment growth is significantly below longer-term labor supply trends. And as a direct consequence, we're seeing an uptick in the unemployment rate and also a decline in the household employment to population ratio. What this signals is a genuine cooling, maybe even a slight contraction, of the labor market's ability to absorb new workers. For you listening, this could mean fewer opportunities appearing and perhaps more competition for the jobs that are available.
And this kind of deceleration, does it come with a risk of a more significant economic shift? Something more severe, perhaps?
Hatzius highlights a very real risk of a sharper downturn. Goldman Sachs currently puts the probability of a recession over the next 12 months at 30%,
30%?
which is, close to the broader consensus among economists. While it's not a majority prediction, a 30% chance is certainly not negligible. It requires significant attention.
30% is definitely a number that commands vigilance. I've heard the term stall speed used in this context. What exactly does that mean? Is the economy nearing that point?
Yes. Hatzius believes the economy is considered close to stall speed. You can think of it like an airplane that's flying too slowly, it loses lift and can quickly fall. In economic terms, stall speed refers to this historical regularity, where the unemployment rate either doesn't rise much at all, or it rises significantly and rapidly. There seems to be very little in between. Historically, an increase of more than, say, half or three-quarters of a percentage point in the unemployment rate over just a short period, that usually signals an economy tipping into recession. While the current unemployment rate is still low at 4.3%, he stresses that this moment requires vigilance. It's a very delicate balance right now.
That's a powerful image, like an airplane losing lift. It sounds like a precarious moment. But it's not all doom and gloom, is it? Our sources also point to potential factors for reacceleration next year. What are those glimmers of hope that could potentially prevent a full stall or crash?
Right. While the remainder of 2025 is indeed expected to be slow, Hatzius does anticipate some significant catalysts for recovery as we move into 2026. One major factor is expected Fed rate cuts. He foresees the Fed beginning to cut rates pretty soon, actually. He's penciling in 5 cuts totaling 125 basis points. That's a significant one, and a quarter percentage point reduction through mid-2026.
5 cuts starting soon.
Specifically, he expects 3 cuts this year, September, October, and December, followed by more next year. This easing of monetary policy, making borrowing cheaper, would certainly be a supportive factor for the economy.
Okay, lower rates would definitely provide some much-needed tailwinds. What else could contribute to a rebound and help pull us away from that stall speed?
Another significant factor is fiscal policy. Fiscal policy, which was actually a bit of a drag on growth in 2025, government actions like taxes or spending, partially due to tariffs maybe, were actually slowing things down a bit. That's expected to turn expansionary in the first half of 2026, so providing a much-needed boost.
Expansionary fiscal policy, so
Right.
like government spending or maybe tax changes.
Exactly. It could be increased infrastructure spending, maybe direct aid or tax incentives. These actions would directly inject more money and demand into the economy. And that increased demand often translates pretty quickly into job creation, especially in sectors that directly benefit from public projects or consumer spending.
So we're talking about a potential shift from government policy maybe hindering growth slightly to actively stimulating it.
Precisely. And then there's simply, well, the passage of time. If the economy can successfully navigate this slower period, the risks of weakness sort of feeding on itself will diminish. Essentially, weathering this storm, allowing those potential rate cuts and fiscal policy shifts to take effect. That could set the stage for stronger performance as we get into 2026.
Okay, this makes sense. But all this talk of revisions and challenges to data quality, it brings a really fundamental question to mind. How reliable are the numbers we rely on? The numbers used to make such critical decisions influencing interest rates, job prospects, even your own financial planning.
Yeah, this is a crucial topic, and Jon Hatzius offers some important perspective here. He emphasizes that historically, U.S. economic data, particularly our labor market numbers, has been, in his words, preeminent in terms of quality globally. He points to things like the timely information from weekly jobless claims. You get those just 5 days after the weekends in our comprehensive monthly surveys. These are examples of data richness that isn't necessarily available in many other countries. So, despite the recent criticisms and revision issues, the foundation is still considered quite strong.
But preeminent doesn't mean perfect, right? I mean, all data has its limitations, surely.
Oh, absolutely not perfect. Hatzius readily acknowledges that all economic data, whether it's government or private, is imperfect. There's, quote, certainly room for improvement, unquote. For instance, maybe speeding up those benchmark revisions so we get a clearer picture sooner, and perhaps integrating new firm creation data more quickly into the monthly payroll numbers could enhance accuracy. It's like trying to paint a portrait of someone who keeps moving slightly. The faster you can get your updates, the more accurate the final picture is likely to be.
And he feels that improving this data is actually a worthwhile investment.
Very much so. He states quite strongly that spending resources on improving data quality has a high payoff because everyone benefits from the most accurate data possible. He's also a strong advocate for, as he puts it, averaging lots of different indicators. Think of it like triangulating your position in the wilderness by looking at multiple landmarks rather than relying on just one compass reading. This multi-data approach gives a more robust picture.
That's a smart approach, getting a holistic view, not relying on just one potentially noisy number. Now, what about the independence of the Federal Reserve in all of this? We touched on past political critiques of data. How does Fed independence tie into this discussion about economic stability and data integrity?
Well, the independence of monetary policy is seen as very, very important. There's a lot of academic evidence suggesting that independent central banks consistently deliver lower inflation rates over time. You can see this by comparing countries with more independent central banks versus those with less independent ones, or even by looking at what happens historically when the legal status of central banks changes towards less independence. It often correlates with higher inflation and greater economic instability.
So independence helps them focus on the long game, not short-term politics.
Exactly. This is especially relevant given there have been past challenges to Fed independence by various administrations. An independent Fed can, in theory, make the tough, data-driven decisions necessary for long-term economic health, free from those short-term political pressures.
Okay, so wrapping this part up, what does this all mean for you, the listener? It seems to mean that the very foundation of our economic understanding, the data, is constantly being refined, debated, and its quality, its potential flaws have real-world implications for everything from your job prospects to interest rates, influencing the very fabric of our financial lives and the decisions you have to make.
Right. And if we connect this to the bigger picture, this whole deep dive really highlights that economic reality is rarely static, is it? It challenges us, I think, to look beyond the initial headlines, to consider the layers of data, the revisions, the expert analysis that truly inform our understanding. Today, we've uncovered a really nuanced picture of the U.S. labor market. We've seen a potential hidden slowdown, possibly confirmed by significant upcoming revisions. We see a delicate balance for the Fed between avoiding a downturn and considering rate cuts. And we've looked ahead to a potentially more robust 2026. We've also touched on the vital importance of accurate, timely economic data and the ongoing debate about its integrity, plus the Fed's critical independence. And maybe this raises an important question for everyone listening. If the very bedrock of our economic understanding, our employment data, can shift by hundreds of thousands of jobs so significantly and retrospectively, well, how confident can you really be in short-term market forecasts or even long-term career planning when the economic landscape itself seems to be constantly rewritten beneath our feet? It truly encourages us, I think, to be vigilant in questioning what we think we know.